Hello everyone. I hope you're doing well today. We are going to go over tax deed and lien investing in today's webinar. I am Corey Daharsh. I've been with Advanta IRA for about 5 years now. Most of my time with the company has been in the capacity of a client account manager. So I've processed thousands of transactions into real estate, syndications, different types of hard money lending, basically a lot of experience in processing transactions on a day-to-day basis, just recently switching over to the education and sales side of things. I'm joined today by my colleague, Alex Perny. He's been with the company a little bit longer than me and had a similar role where he was in client account management for 4 years or so, if I'm correct, Alex, and then switched over to sales and marketing and education a little bit before me. He's been in that role since I've been with the company. Alex, anything else about your background before I move on to the next thing?
No, just you kind of hit it on the head. Just enjoy helping people realize their goals of retirement plan investing with some great alternatives. So we're excited to bring this content today. Just keep in mind that the content that we're going to be providing is in the context of doing these things through an IRA, so tax deed, lien investing, certificates, all these kind of things through an IRA is the overriding context. So I'll let Corey take it away for the first half of the presentation, and I'll jump on the backside and show you all how to actually functionally do these things through an account. Thanks, Corey.
Yep. And everyone, if you are trying to take down our contact info, it will be up on a slide at the end of the session. So if I didn't give you enough time right now, don't worry, we'll have this up in front of you again if you want to reach out to Alex or I. So I do want to provide a brief disclaimer before we get any further. Advanta does not endorse any specific products, and we are not conveying advice today. All information is for educational purposes, and we do encourage everyone to consult your own team of attorneys, accountants, financial advisors, and other fiduciaries you may be working with before choosing any specific investment or strategy. If you're not familiar with self-direction, what a self-directed IRA is a specific type of retirement account that allows you to invest into basically anything available as an investment without being limited to specific products offered by the larger type IRA custodians. So with alternative investment custodians like Advanta, you can set up an IRA account and or a 401k, other types of retirement plans to invest into real estate, hard money lending, precious metals, foreign currency. We're seeing a influx of cryptocurrency investors right now as well. But basically, the rule from the IRS's perspective is as long as it's not a life insurance policy or deemed to be a collectible or a hard to value asset like fine wines or antique vehicles, you can pretty much hold anything else in your retirement account with a self-directed or alternative investment custodian like us. There's a few reasons people actually choose to self-direct once they hear about it. It's a new source of capital. A lot of people that are real estate investors find out that they have the ability to utilize their retirement account for the real estate investments they're already doing. So they tap into extra funds for those types of purposes. Stock market fatigue is also a big thing right now with the market going up and down and just kind of being pretty volatile. A lot of people are trying to diversify and get better control of their returns in their retirement funds. And also the tax benefits, specifically today with our topic being tax deed and lien investing, we're going to go over some strategies and options you can do to get a hold of either real estate or these tax deeds and or liens in either a tax deferred or tax free status, depending on the type of account you have. One of the things that Advanta takes great pride in is providing a very vast learning and education department where we host events like the one you're seeing today or watching off of our YouTube channel. And we also have a great blog that's got industry news, upcoming legislation changes, and things like that, if those are items you're interested in. So please feel free to check our website for our upcoming events. our YouTube channel for a robust catalog of videos with guest speakers and specific topics, and also our blog if that's something that's interesting to you as well. If you are looking to get started with a self-directed account for alternative investments, it's very simple. It only takes about 15 minutes to complete our application. You get paired with a dedicated client account manager, which again is the role that I served for about 5 years, Alex served for about 4 years, and that person's your dedicated person at Advanta that'll help you with all of your questions, concerns, processing investments, going over strategies and things like that. Funding the account's very quick and easy as well. You still have up until May 17th to put in a cash contribution for calendar year 2020, and you have up until next year's tax filing deadline to contribute for 2021. And you could also roll over funds, which is a big thing that people find out about and utilize. If you've got a former employer 401k plan, a TSP plan, a lot of ex-military individuals have those types of plans that really aren't working for you until you get a hold of it and start self-directing it after you've left that employer. And basically you could start investing. Once we receive the money, you'll be partnered with your account manager and you can coordinate any investments you'd like to place. And today, again, we'll be going over tax deed lien investing, and Alex specifically will go over a few different versions of that type of investment strategy. Oh, sorry about that. I have a colleague calling me. My apologies. There are a few different types of plans we offer at Advanta. Basically, any of the retirement accounts you see here can be self-directed. A lot of people are familiar with traditional and Roth IRAs, and there's also some other types of plans if you're a small business owner or self-employed, education savings plans for your children, or even health savings accounts for yourself as an individual or to cover your family. So now that we've gotten that information out there, I want to just give you a brief synopsis of today's agenda. I'm going to cover what tax deeds and liens are, quick pros and cons of the investment strategy so you have a grasp of what you're getting into with this type of investing, how to start investing, and then we'll go ahead and hand that off to Alex, and he's going to cover a few different case studies on specific ways that you can structure investments into either tax deeds or tax liens, also commonly referred to as tax certificates. Again, as Alex mentioned, please feel free to type your questions into the chat box, in the question box. We'll answer those as we go, and typically set aside time at the end to go over anything at the conclusion point as well. So to get started, let's go ahead and look into tax certificates, which are also commonly referred to as tax liens. If you're looking at investing into certificates or deeds, it is very important to check with the local area that you're looking to invest into. Each county and municipality handles their certificates and deed sales differently. We're pretty familiar down in our headquarter area of Pinellas County with how they do that, but you could be looking to invest in whatever your local area is, or even an area that you're not specifically living in if that's where your target market is. So please check into the way they handle it. Sometimes it could be over-the-counter sales where you just go into your tax assessor's office and ask for any tax certificates available for purchase. Most of the time, the deeds are sold at auction. Sometimes those auctions are online digitally. Sometimes it's actually on the county court step, like you would see in the old version of Monopoly. Basically, once you have the tax certificate purchased, you'll be owed the money from the owner of the property to pay back those back taxes that they owe. The way that these certificates typically get to be sold is the county, after a certain period of time, will try to clear any of their bad debts and sell the right to you, the investor, to collect on those unpaid taxes. The rates of return for tax certificates typically are about 18% or lower. We're not usually seeing a higher rate of return on these. And it is very important to note that when you're investing into tax liens or tax certificates, you're not actually investing into the right to the real property. If you do have a tax certificate, you kind of can help push that tax deed to go to auction if you're not collecting on the certificate you own, but you would still need to furthermore attend the auction to buy the deed to carry over and own that property if that's inevitably your goal with the investment strategy. Flipping over to talk about tax deeds specifically, these typically go for sale when the taxes are delinquent and the certificates are not paid on or have been just delinquent for too long and the county's trying to recoup some of its initialized losses there. The county will typically sell or start the auction on the delinquent taxes. You purchase that tax deed at auction, and then you have the ability to pay back the taxes, clear any other liens that are on that property. Keep in mind, if there's any other liens against that property that was maybe the reason that the owner wasn't paying the taxes on it, you will have to clear all of those liens before you can actually take on ownership of the property in itself. So the pros and cons of tax deed and lien investing, when you are initially starting out, you can typically invest what would be a smaller amount with the expectation of a quality return or the ability to force the property to go to auction. If you win at a tax deed auction and you clear all the liens, you can ultimately end up owning a property outright, whether it be tax-free or tax deferred. So in an ideal scenario, you're looking at a strategy where you're only spending a few $1,000s on a tax certificate or potentially, a portion of the actual value of a property at a tax deed auction. You clear any other outstanding liens, which, there's going to be associated expenses. And keep in mind, all of these expenses must be paid out of your retirement account to be qualified and part of the retirement investment strategy. But once that's done, you can end up taking title of the property in the name of your retirement account. I think there's a scenario Alex has dealt with in the past out of Atlanta. I was just kind of reading up and listening on this recently. We've had an investor in his specific municipality buy a tax deed and clear all the liens at a total cost of about $150,000 or so, and ended up selling the property years later for just over $1 million. That is extenuating circumstance and a very gleaning case study, but it's just a potential option if that's part of your strategy and that's the way it works out in your case scenario. Some of the cons with tax deed and lien investing is that you're usually dealing with a distressed asset, whether it be a property that has, other outstanding liens, and that's why the owner decided not to pay the taxes or didn't have the ability to, but you're usually not getting access or ownership of a property that's in perfect condition to turn and sell it immediately. You may have to do some updates to the property. As I mentioned a few times, you may have to clear any other outstanding liens, but those are all part of the strategy just to be aware of as you're getting into this type of investments. When you do invest into certificates, like I said as well on the last slide, you do end up having to separately go to auction if you're ultimately trying to claim the property and you're not getting paid on the certificates you own. And when you invest into deeds, again, you just have to clear all of the liens before you can take the ownership of the property. Now, with those pros and cons, I see we have a few questions popping up here. Alex, do you want to cover these questions before we jump into your case studies, or do you want to hold those till the end?
Yeah, we could just quickly kind of fire through them. Bob had asked regarding an individual that had lost a property for $1,700 in unpaid taxes, and the seller of the deed wanting a considerable multiple on that. Unfortunately, if someone does buy a tax certificate and then applies for the tax deed to the property, they in turn, if they do receive it and that individual never paid off the tax bill, the back taxes that were owed, that other individual does then legally own the right to the property. They do have to clear any other liens or encumbrances to that parcel. But unfortunately, if they are looking to sell it back to that individual, then then they kind of can set the rate for it. If there are other extenuating circumstances in that, maybe have the property owner talk to the county to make sure everything was done correctly as well. Yeah, and if anyone wants a copy of the slides, feel free to just email us. You can grab that at the end of it. It's CDAHARSH at Advanta IRA or APERNY at Advanta IRA. And before we turn it back over to Corey, our Brad asked, are returns from investment subject to UBIT? Not in this particular case. UBIT really only applies if you're purchasing an interest in a non-C Corp operational entity for the purposes of operating a business, or if you are utilizing debt, as in you are borrowing money, your IRA is acquiring debt in order to purchase an asset. So that really would not apply here. And with that said, I'll turn it back over to Corey, because it looks like we kind of finished up through those questions.
The only other question really was Dinesh asking for a copy of the presentation. So at this point, if you wanted to flip to the next slide, it would actually begin your case studies.
Oh, cool. No, let's right away through it. Yeah, we'll get everyone out of here a little bit quicker today. It's these are a little bit more of a truncated. There's not a whole lot that kind of goes into these. If you do want to invest in these types of things, it's just kind of mainly looking at the county in which you like to purchase, or the actual avenue that you would like to purchase them through. So it's something important to remember that these aren't inherently the most complicated things to actually get involved with, and the nice thing is they can be significantly lower value, but just like with everything, there's different things that you're buying, whether that different counties have different counties and states are going to have different procedures for actually applying for deeds. If you want to actually get into where you acquire a property and you don't just want the repayment of the debt that you have taken off of that particular county's tax rolls, keep that in mind, is that everything is going to be different, and it's really impossible for us to get into the entirety of that in a short presentation. So check with those local counties, bring us the questions, say, hey, if you're going to do this through an IRA, we can kind of show you how it works in a more specific scenario. So just keep that in mind. And before I kind of get into this, I'll just finish the last question. Linda asked, does the owner of the property have a waiting period during which they can still redeem the property after you've purchased the deed at auction? So once it's gone to a deed auction, that is kind of the last step in the process. So in the process of, let's say someone doesn't pay a tax bill and they have X, and again, this varies from state and county levels. You had not paid your property taxes on a piece of property, and it has accrued with the particular county. The county is then selling that debt to someone else to collect on. So they receive in cash, and then the individual holder of that certificate then has the right to collect on that. If that individual hasn't repaid that tax debt to the person who's purchased the certificate or deed, or sorry, the certificate or lien on that property, then that individual, as the one that bought the tax certificate from the county, as Corey indicated, can then apply to have a tax deed issued. In some counties, those will go to a separate auction. In some cases, the certificate holder has the first right to apply for that at the county. So essentially, after it's gone and there's a tax deed issued, that means that the person that held that debt owns the property. So unfortunately, there's really not much that can be done with the county. Now, that's not to say that that can't always be done. Things are definitely very procedural. You have to make sure that it is done absolutely correctly, because I have seen properties being clawed back by the original owner after someone's applied for a deed. Now, that is definitely not the most common scenario, but can happen. So just keep that in mind. Yeah, and Sue Ellen, again, just going right back to that, you're exactly right. The redemption period is different for every county and scenario that you go into. So some might be very stringent, very short, for the amount of time that the person has to either start repaying or fully repay that tax debt before they can apply for the tax deed. So just keep that in mind. A lot of different things around there. And just to make sure. All right, great. So with that said, let's get into a little bit of the things that are going into how do you purchase these. Now, it's easy enough to say that you go and you bid on these things. Well, what does that mean for an IRA specifically? It's easy for you as an individual person to say, hey, I'm going to go bid on something. Quick Google search, county, set something up, you're bidding, put a credit card in there. Definitely a little bit of a more involved procedure with doing that with an IRA. So there's a few different ways that people do these with IRAs. One is they'll directly use the IRA to go in and bid on these tax certificates. Now, that definitely is going to be probably the most straightforward and familiar way with most people doing this. It's not going to involve kind of learning any other extraneous procedures or functions, such as using like an ND, like an LLC, which we'll get into, or using like a secondary service. You're interfacing your IRA directly with that county. With that said, I'm going to heavily preface this by saying that not every county will interface well, efficiently, or be able to with an IRA. This is kind of a best case scenario, and I'm kind of going to be going off of some examples here in Florida locally to us. Now, what you have to keep in mind is that since these counties are auctioning these things off, they set their own procedures. There's no universal procedure for selling a tax certificate or selling a tax deed. These procedures and the way that this happens for these auctions are set incredibly varied across the United States. Some might require that you actually bring physical cash, which wouldn't really necessarily be feasible for an IRA to do. They might require a cashier's check, same day be delivered to them for the purchase of the tax certificates. Again, not something that can always be done unless you're local to our Tampa Bay office, and even then, it might be a timing issue with getting that done. So counties that allow for things like bank wires to be sent are a good fit for this type of scenario that I'm going through right here. Counties that allow for the total purchase price to be wired the following business day by, let's say, like 10 o'clock in the morning, even better. It just gives you some time to allow these things to be operationally feasible within an IRA. So again, I just like to heavily preface that depending on how these counties actually set up their sales is really going to be the main driving factor into which of these three processes you go with, and more so to do with the first and the third. The second one can kind of work, in most any scenario. But in this case, John wants to use his 401, wants to use a 401k from a previous employer to purchase tax certificates in counties around him directly in his IRA. In this case, we're just going to say it's around Pinellas County in Florida. So what does he do? So first thing he needs to do is open and fund an IRA account, meaning that he completes the paperwork to open up the self-directed Advanta IRA. He rolls over, transfers funds from another IRA. So he has the funds here. Then he needs to set up the bidder account with the county. Now, specifically here in Pinellas County, it's as easy as going on to the Pinellas County Clerk of Court website. You can register your bidder account. You can tell on that bidder account exactly how you want to have the titled owner show up on the certificate, which is great. It makes it very easy for us to record keep, and especially in that scenario, you only have to fund about 5% of the total 5% of your total bidding amount for that purchase account. So he submits the paperwork to have Advanta fund the initial deposit to that bidding account. Now, Advanta in this scenario, we work with John to ensure that the bidder account is in the name of the IRA. So you can, print page, you can show us, hey, this account is in the name of the IRA. So that way we can make sure that everything, once he's actually finished buying everything, is properly titled in the name of the IRA, because I'll get to that in a moment. But the name of the game for buying things within an IRA in any context really is making sure, for the alternative side of things, that it's properly titled and record kept in the name of the IRA directly. That's how you get all the great tax benefits. That's so you don't get anything mixed up with your personal taxation. So for us to make sure that that bidder account is in the name of the IRA is very, very, very important. Now, also keep in mind that certain counties might have character limits. Again, this is kind of going back into which one of these three procedures that you choose to go with, is that this is not always going to be the best fit for you. And especially with doing these things, sometimes utilizing a checkbook control LLC, like we'll get into, can really kind of help things for you. But again, not everyone wants to necessarily do that. So again, we work with John to make sure that to ensure that the IRA is properly titled as the titled owner of the certificates after the bidding is complete. We wire the purchase funds after he shows us the fee calculation worksheet, and this can be, again, called something different in every county. Essentially, after you're done bidding, the county will provide you with a ledger sheet showing, hey, John, you purchased, 20 certificates. Here's the face value of each. Here's the fees that we charge, and then here's totally what you need to bring us to finalize the purchase. That's kind of what the client needs to provide to us in this scenario, and then we send the money out. And again, that's kind of the big determining factor in how you kind of choose which way you want to go, is that since these are all incredibly different, and if you especially want to do certificates in different counties, making sure that the IRA can directly interface and send funds in a way that is operationally feasible, something like a bank wire, or if they can, wait for a check to come in the mail. If they need payment that day and they don't accept bank wires, might not necessarily be something the IRA can directly do the investment with. Okay, so here's what it would look like here in Florida. We have an 18% cap on the interest rate for certificates, at least here in Pinellas County. And I think that is relatively universal with the state of Florida. So in this case, Joe bids on $30,000 worth of tax certificates, and he gets them. So the certificates are paid off in the following year. Joe's IRA collects the Florida 18% interest on the payments. So no taxes are going to be paid by the IRA. So the holder of these certificates, $5,400, is going to be completely tax exempt coming back into his IRA. So he gets his principal plus the interest on those certificates repaid. So now within this span of a year, he's made his 18%. So he has $35,400 now in order to go back and either reinvest in another tax deed sale, or he can elect to invest in other alternatives. But the great thing is that once these are paid off, then he has the ability to utilize those funds without any type of ceasing period. He can turn right back around and reinvest into other alternatives without having to worry about escrowing any type of tax payment for himself. Now, keep in mind that if some of these don't pay off and then he wants to apply for a tax deed for some of these properties, he can do that at this time as well. But essentially, the thing to look at is that any of the payments from these certificates are going to flow directly back into Joe's IRA. And just so we can make sure that we're covering questions, I'm just going to scoot back.
Yeah, Alex, I can read Jeremy's question here if you want me to. That's really the only one that has come through since, and just one new one here in a second.
Yeah, if you want to go ahead and read that off, we can get that answered.
So Jeremy asks, or it's a statement with a question at the end. I had a property under contract to buy. After further investigation, the seller did not have full right to sell the deed and were needed from their heirs. They refused to sign, thus stopping the sale. The title exam revealed a tax lien where Investa purchased the certificate. It was not coming up for an auction, and we did not know it when it would occur. The only way to purchase the home, other than working it out with the heirs, seemed to be buying it at tax auction. Do we have to wait until the investor decides to move it to auction? So basically, it seems like Jeremy's just asking if there are any other recourse or capacity to get ahead, being that he had the property under contract first.
Well, that's a good question. It depends on the investor and the county. These things kind of circle back, and I hate to kind of be not answer your question. It's not from a lack of wanting to or knowledge, but actually it is a lack of knowledge, just because all these counties are so incredibly different and states are so incredibly different. So let's say in this case, this tax certificate is owned by an individual. Let's say in this case it's me. I own the tax certificate on that property. Now, the owner of that property, due by non-payment, if I have then in turn applied for a tax deed for that property, I may be obligated to wait that out. Now, if it's going to go to auction, now let's say I don't have necessarily the right of first purchase for that tax deed once applied for, and it has to go to auction. If that process has been started, sometimes it can't necessarily be stopped by anyone other than the property owner paying that tax bill. So if none of the heirs of this estate, which it sounds like, obviously you're trying to purchase this thing out of probate, or if it already has been a probatable asset and gone to the heirs, that can obviously be a big issue. Now, again, it's like I said, I can't necessarily answer that specifically, but you may have to go to auction. You may have to wait for that to occur. If you can corral these heirs into paying the tax bill, or working that into the contract somehow where the bill is paid and the certificate is canceled, and then you can go to closing and then maybe work out some type of net closing price for them to make up the difference in the tax bill that they had to pay. You can certainly try to work something out, but again, it's all going to kind of circle back to the particular county, the particular state, what their regulations are, if that can kind of be done. And then Andy brings up a good point. You could potentially buy that tax lien from the investor that bought it. So to kind of circumvent that. And again, that's that can typically almost always be done, but you're going to have to keep in mind that just like with everything I said, you got to check with the county, because if there is some type of restriction on conveying that, especially if they have applied for a deed or something, that can kind of throw a wrench into those things. But if you are able to purchase tax certificates on the secondary market, if the investor's already purchased one, make an offer to them, buy it. Then you don't have to worry about it going to auction, and you kind of control that property a little bit better as well.
Perfect. Thank you, Alex. Andy, always a pleasure to have you participate and help out. I have another question I was going to answer real quick from Lalith. Can you transfer, sell, or deed over the tax lien to the IRA? It seems like that question is based off of if you own the tax lien or deed personally, and the answer there is no. Unfortunately, that would constitute a prohibited transaction. You yourself as an individual are not able to do any dealings with your retirement account. So it would have to be purchase or sale directly through a third party in your retirement account, but you cannot transfer ownership from yourself as an individual into the retirement account.
Yep, great, awesome. Let's see. So with regard to educational materials, a few other people have asked on, they can get a little bit deeper into this. Yes, if you go to our website, we have had several big educators, especially in the state of Georgia, come on and do kind of a more of a masterclass type of drill down. So I'd recommend you go to advantaira.com, search tax deeds and liens on our education tab, and it will bring up some of the other guests that we've had on. Again, this is more kind of just the basic, the 101 class. If you want to get involved in this, here's kind of a few different ways you can do it. With that. So with that said, I'll keep asking the questions. We're going to get in. We just want to kind of make sure we keep this thing rolling. So the other way to kind of buy these things. So there's kind of two ways left. One is buying through a brokerage. Now, just like with any type of brokerage, what that means is that someone is acting as an intermediary in this purchase. And the nice thing about this is that it can make the buying process easier for you as the individual, but you're going to give up some stuff. Typically what you're giving up is either some type of cost, so you're going to be paying some type of fee to this brokerage, or you might be getting less than the face value interest, which would kind of work into a fee. They collect that on the front end and then net out just a rate of return to you as the investor. But the nice thing about this is that you're going to be kind of shielded from a lot of the different parts of the spectrum that are kind of arduous. A lot of the different research that goes into different specific counties, because that might be taken care of on a corporate level with your account. Now, what you may lose out on is that you may only be getting rights to the interest payments. You may not be getting rights to the deed application, or you may. It's going to vary widely, but just understand that there are services out there that you can interface with as either an individual or an IRA that are going to kind of step in between you and the actual county selling these certificates to allow you a greater degree of or a less degree of work on your end. So you can just kind of place the money into a certain asset class, in this case tax certificates, and then realize a return without having to get as drilled down into this. But keep in mind, with that are risks. You have to be confident in that company to actually properly buy, allocate, and purchase and fund these tax certificate sales. So just like with anything, if you're giving your money over to a third party, you have to have that kind of trust involved. Now, with that said, Linda wants to buy some tax certificates, but she's kind of in the boat of people saying, hey, you know what? I would rather just kind of get into an asset class rather than so much of drilling down into each one of these specific counties, learning all of the minutia that goes into these things. I would rather just have something that's based in an asset class that I understand, that's outside of the stock market, but again, don't want to have to kind of deal with some of those nut and bolt details. So she has about $100,000 in IRA money to invest. She finds a service that bids on tax certificates on her behalf as a collective group. So they pool the money together as a collective bidding entity, and then they purchase these tax certificates. And they estimate receiving 15% annually on the certificate payments on her initial investment. Again, You need to be comfortable with that. You need to read through what their disclosures are to make sure that you are going to be placing your money with a reputable company. Unfortunately, we cannot recommend any companies to you in this capacity. If they are selling a service or a product, it is ultimately going to be to you to make sure that it is a good fit and you feel comfortable with what they are providing. Now, in this case, what do we do versus what Linda does? Because it's going to vary a little bit differently from the first scenario I gave you. So in this case, she still needs to open up an Advanta account. She needs to identify a tax certificate brokerage service. She sets up the IRA. She sets up that account in the name of her IRA. So just like the bidder account for the particular county needing to show that the certificates are going to be issued in a certain name, be it the IRA, in this case, you're going to need to make sure that the brokerage account is set up in the name of the IRA, so that way when she goes to purchase stuff, it directly is, allocated, that tranche is allocated to her IRA correctly. So we would need to be provided with that brokerage application. She would submit all the paperwork to Advanta. We would review it, execute it, work on her behalf to make sure everything is properly titled, and then ultimately wire the $100,000 to that particular brokerage she's looking to use for that. And then from there, at that point, it's a little bit of a, with most of these types of service providers is a kind of a set and forget. They provide the service on the back end for collection of those payments, allocating your profits to what you have purchased to your IRA in this case, issuing a check or some type of electronic payment back to us. And then if there are any type of scenarios where there are tax deed applications, typically they'll kind of build that into their fee structure, or depending on how they work it, you may or may not have rights to that. They may collect it, they may be the ones that have the right to that. So again, make sure you read any type of brokerage agreement with regards to these types of companies out there. There are certainly good ones. We've had clients have good experiences with them, but just keep in mind, you are giving your money over to someone else at that point to do the investing for you. So just be wary, do your research, make sure that you get into something that is going to be a good fit for you. But again, this can remove that degree of work that is required for some of these types of investments. Now, keep in mind that what really needs to happen here, and this is important with any type of tax deed investing, no matter if you're doing it directly through the IRA, if you're doing checkbook control, the ultimate titled owner needs to be in the name of the IRA. So in this case, the brokerage account would need to be titled in the name of Advanta IRA for benefit of Linda's IRA number. All of the returns have to come back to the IRA. So especially if you're doing all the interface, you're signing into this brokerage account, making, allocating your funds and everything, you need to understand that if you ever want to take money out of that account, or if there's ever profits generated from that, they come back to the IRA first. And if there's any expenses related to the IRA as an investor on that account, don't put your credit card down. Make sure that it's deducted from the IRA funds, because the IRA is going to be liable for any and all expenses related to that particular, related to that particular purchase through that company. So keep that in mind, that the IRA is solely responsible for the expenses related to the investment through that particular brokerage. So make sure that if they do offer the option to pay with a credit card, you don't put that down. You just have them deduct fees from your applicable IRA balance.
Alex, before we jump into case
Yeah.
study 3, Leslie had a question. Do these make sense for someone who is subject to RMD, and how are they valued for RMD? As far as making sense, I know that we really can't speak to that effect. That's kind of a tax or fiduciary style question. But can you just speak to how tax deeds and liens end up being valued relative to that?
Yeah, well, we can get a little into that. So Leslie, it's first off, great question. Especially with people getting older, it's important to understand that if you're going to get into things that are, I wouldn't say that these are highly illiquid, but not liquid or cash alternatives. So with that said, if you purchase tax certificates or tax deeds and your required minimum distribution age, unless you have funds that are liquid in nature at other brokerages or other IRAs, you might be getting into situations where you have to do either an in-kind distribution, or you might have to try to sell these assets in order to have a cash distribute. again, that's just going to be kind of something that if you're okay with that, fine, but it's not necessarily going to prevent you ever from doing a required minimum distribution. But I would say 100% you need to be a little bit more aware, do a little bit more research to make sure it's a good fit if you're of RMD age or will be of RMD age when you're investing in things that are less than liquid or highly illiquid. So just keep that in mind. And then we have, I think you answered Jeremy.
Yeah, I just answered Jeremy's question. You can say it out loud if you'd like, or either way.
Yeah, so Jeremy asked just for anyone else that might be some good information to have. To be clear, checkbook IRAs do not need to have the custodian listed when receiving or making payments. My IRA is invested in a single member LLC where the IRA cash is held in a bank account, and that is absolutely right. This is not going to be by any means kind of a masterclass on utilizing a checkbook control IRA or LLC. I would recommend anyone that wants to learn more about that. I recently taught a class on checkbook control IRAs. Again, advantaira.com/events /learning center. You can see all of our catalog videos. It's one of the more recent ones. Take a look at it. We're going to kind of get into the basics here, but again, this is where you're going to kind of get into a little bit of an intermediary, and a lot of people that do tax certificate investing like the checkbook control format. And the reason is that it allows for them to directly interface an entity that they tightly control. So whereas with the IRA being the title owner of a tax certificate or bidding on it, one, the county has to allow for, the character limit of having the IRA title on our tax certificate, which sometimes, depending on some antiquated systems, can be an issue. Two, they have to be able to receive payment directly from the IRA in a time frame that would make sense. Now, obviously, we are an IRA administrator. We have to follow our policies and procedures. So paperwork has to come in, be reviewed, sent back out. Although we strive to have a very quick turnaround on things, typically with auctions within a day or 24 hours, sometimes even that's not fast enough. So utilizing something where your IRA invests into, for easy digestion, a holding company that you've set up specifically for that IRA, and then that you can write checks out of, hence the checkbook control terminology for this, then you might be able to get involved in more counties than you otherwise would have been able to directly with the IRA. But you have to kind of be comfortable with the scenario as a whole with checkbook control. So in its most basic sense, checkbook control is when you have your IRA, you funded your IRA, you set up a new single member LLC. You can use a trust, but most people like to use an LLC. Set up a new single member LLC that the IRA is the sole member of, that you are named as the manager of, and then once the funds are in the operating account of that LLC, you as the manager interface with whatever particular county that you're looking to interface with, and this can also be brokerages, really anything that you desire with regard to this asset class or other ones as well. You interface with that, and then you have the flexibility of, let's say they issue the calculation worksheet for how much you owe for that, and they need payment immediately. Well, you can go immediately onto your bank's website, wire money out. If it's someone local to you, you can go pick up a cashier's check, drive it to them. You have a greater degree of flexibility with how fast you can operate with these things with checkbook control LLCs than you would with dealing directly with us as the administrator of the account. So especially when it comes to auctions, and this can apply to things like property auctions as well. If you're just buying foreclosed properties at auction, these things work very well to that. But keep in mind that you are ultimately responsible then for record keeping and doing all of the proper accounting for every single cent that is spent and every single investment that is made by that LLC. So if you're not someone that likes to take care of paperwork personally and do record keeping and accounting, might not always be the best fit for you to use a checkbook control LLC. Maybe try doing some tax certificate purchases first directly in the IRA, then graduating to the checkbook control LLC, just because a lot more of the onus and responsibility is going to be placed on you as the client. Now, with regard to how this works, again, by no means a masterclass, just the basics here. Joe opens and funds an Advanta IRA account, which means he completes the application, transfers money over from an existing IRA or old 401k. We get the account number issued. Now from here, Joe is going to need to choose the state to set up the LLC. Now, you don't have to worry about taxes because with a single member LLC for federal tax purposes, it's typically considered a disregarded entity, meaning that it doesn't need to file a tax return. The member is tax exempt. So, choosing one on a particular state's tax implications really isn't, always kind of the most sound course of action. I would recommend, and again, this is not, tax or legal advice, pick a state that has an easy annual registration procedure. Florida's a good one. Most of the states in the Southeast are pretty good with that, including Texas, and one that doesn't charge you an arm and a leg annually for your registration as well. Because on top of the fees that we charge at Advanta to administer and record keep and report an IRA, you're also going to be into that state for whatever they charge as well. So keep that in mind, that you have, some other things that are going to kind of add up here. So choosing a state that has easy reporting requirements and not a whole lot of fees to annually register the LLC. And to give you an idea of what that is, the state of Florida, I believe, is about $180 a year for LLC registration. Pretty much anything on the West Coast is going to be very expensive, and states that have very, very large metro areas. So think your Illinois, think New York, Pennsylvania, states that have large cities and large population centers typically tend to be a little bit more expensive. Doesn't always necessarily hold case. Texas is cheap, Florida's cheap, but keep in mind that's kind of what it looks like. So Joe, in this case, chooses the state to set up the LLC, choose the name for the LLC. You get to go crazy with this, anything you want. And he uses his own personal tax professional or someone else he chooses, and we can refer you to people to actually draft the LLC operating agreement. So the articles are just going to name Joe as the manager. So you can certainly go in any state, and I'll use Florida for an example. You go to sunbiz.org. You can in the eyes of the state of Florida, you can start an LLC. That's not what we're looking for. We need to be provided with a copy of the operating agreement that shows the IRA. So if you look to the right, Advanta IRA, FBO, Joe Smith IRA as the titled member on that operating agreement. That doesn't go to the state. That's what shows the agreement between the IRA and the entity to fund it, and also who the manager is for our purposes as well. The IRA needs to be listed as 100% owner, and the operating agreement must show the IRA as the member. So from start to finish, open the account, choose the state to set up the LLC in, choose the person to draft the LLC operating agreement, IRA is named as the member, and then ultimately we fund that operating account for the LLC with funds from the IRA. Then Joe has the ability to purchase certificates in any county that is administratively feasible for him to do so. Any of the certificates issued that he purchases are going to be held in the name of that LLC directly. And if there's any type of deed application or deed auction that he wants to participate in, the LLC would directly interface with that. Advanta is not directly involved with those types of dealings on that side of things. So keep in mind that from start to finish, Joe opens the IRA, gets the LLC done. Once the LLC is funded, then he can in turn go and interface with the counties that he'd like to purchase the certificates that he's interested in, and then any ongoing operations are performed by the LLC directly, not the IRA. So payments on those certificates go back to the LLC. Any type of deed applications or deed auctions are done through the LLC. Now, if he ever wants to take a personal distribution or move cash to another IRA custodian, the funds do need to come back to us first, and then we move them out. And that's very important because, especially with using an LLC, it does open you up to maybe having a few issues with regard to things like prohibited transactions and making sure that you understand those rules very well. So although it does give you a high degree of flexibility with how you operate the IRA, especially with things like this, where you have so many different procedural issues with different counties and different states, keep in mind that you really need to be very well versed on IRA rules, which we can certainly help you out with. But just keep in mind that that's definitely something you need to be very up to date on, and procedural aspects as well. And I like to include this slide because people often ask, especially with IRA owned LLCs, well, is this legal? Can I do this? This seems a big departure from anything that I've heard before. Or people say, hey, I thought I couldn't have any direct touch. I can't touch the money that's in my IRA. This kind of seems like I'm touching it and being a little bit too closely involved with it. And these are all great things to be concerned with, but the IRS has looked at this several times. There are some more recent court cases that have examined this type of investment structure. The two main ones that people kind of look to for verification of this are the Swanson v. Commissioner case of '96, but I strongly encourage people not to kind of base maybe just their sole opinion on that case, even though it's kind of what you'll kind of find in Google most often. The guy was actually paying himself a salary for his managerial duties in that case, which is definitely clearly a prohibited transaction. They just weren't looking at that part of the case when the IRS sued him. And then he turned around and sued the IRS for his legal fees and won. So he kind of painted a picture on his back. I don't recommend that kind of be the only thing you look at, but it is kind of the start of people looking at this and the IRS kind of repeatedly affirming that the structure is indeed good. TC Ellis of 2013, similar situation. They examined it. Ellis actually lost that case to the IRS, but they specifically notated in their ruling that the IRA owning an LLC and the management of that LLC being done by the client was not an issue. The issue was him paying himself a salary for it. So again, there are definitely some additional rules and regulations you need to brush up on if you want to use the checkbook control method to purchase tax certificates. We have a lot of clients that use it to great effect, but it's not necessarily for everyone. And it's maybe one of those things where if you're very new to all this, walk, crawl before you run is what I'd recommend. So maybe starting with a local county that works with an IRA directly, or just make sure you do a lot of research, call us, talk to other people that have done it, and just make sure you understand the regulations regarding that. So what I thought was going to be kind of something that was brushed up really quick, it looks like we almost filled up the hour, which is great. Just make sure we don't have any other questions that popped up. Feel free to answer or ask any questions of Corey and I. I will put our contact information directly up on the screen. Again, thank you very much, everyone, for joining us today. I know I really enjoy kind of getting this information out here and teaching people things that they otherwise don't know with regards to how to structure investments, utilize self-direction, save on their tax bills, build wealth in these tax qualified plans. I hope it comes across. Hope you enjoyed it. Let's see, we have a question from John. Does a checkbook LLC typically pay taxes on income earned? And the answer is no. So the checkbook LLC really acts as kind of a managerial extension of the IRA. It doesn't change the tax status of the IRA in most cases. I always have to kind of preface when I answer that kind of thing, because there certainly are scenarios where you could get your IRA into a taxable scenario. So I wouldn't say with 100% certainty, yes, but if you're just going to be buying tax certificates with an IRA or buying real estate or tax deeds, you're not going to, in almost any case, run into a taxable situation. So does the checkbook LLC pay taxes on income earned? No, but again, just make sure that you educate yourself on what you're doing to see if you would potentially ever have an issue.
And real quick, I wanted to also call back. Alex had mentioned earlier in the presentation that recently, I think a few months ago, maybe 2-3 months at most, he hosted a webinar on checkbook control strategies. I also just 2 weeks ago or so hosted a webinar that's basically a 101 on how to get started and what checkbook control strategy is. So please feel free to check out those contents as they relate to your interest and due diligence, whether it be on Advanta IRA's website or youtube.com/Advanta IRA. They're all hosted there, as will be this recording. Typically takes us about a day or so to get this recording up on to our YouTube page, but someone had asked that in the chat as well, and I wanted to make sure I reiterated that.
Yeah, absolutely. All right, so let's see, we also got William asking, is it possible to have a hybrid checkbook LLC and Advanta doing the management? No, unfortunately, that is not a service that we offer, just because if we are going to be doing the administration of the account, we need to hold the cash. We need to have everything directly here. It's just not work like that, unfortunately. So you would need to, again, if there are parts of this that you're not comfortable with, then I'd recommend doing the IRA directly for that. Let's see. Lilith asks, would the same apply to the HSA and ESA as far as showing them as members of the LLC as well? Yes, you can certainly have ESAs and HSAs be a member of an LLC, but one big thing that you're going to need to keep in mind, I mentioned it earlier, is that when you have a single member LLC, for federal tax reporting purposes, you are more often than not considered what's called a disregarded entity, meaning that you're disregarded from needing to file a federal tax return. Now, even if an IRA-owned LLC does need to file a federal tax return, it doesn't necessarily mean that there'll be federal taxes due, but you have to file one. So if you have multiple members of a singular LLC, you are no longer considered a disregarded entity, even if it is all IRAs that you own. So let's say it's your HSA, your traditional IRA, and your Roth IRA, and you want to combine them into a singular LLC. You can absolutely do it. But you create a situation where now, instead of the single member disregarded entity, you have a multi-member LLC that is going to have to file a federal tax return. Now, will you owe any taxes on that federal return? Probably not. Again, depends on kind of what you're doing, but more often than not, you're not going to have anything owed on that, but you're going to have to pay someone to file that federal return for you, or you would need to know how to do it. So while, that's kind of a good answer that Corey gave, it definitely needs some additional information on the back end of, is it always a good idea? Maybe doing individual LLCs for each would be cheaper, especially when factoring in, state costs and tax reporting purpose things. So just something to keep in mind. Lisa asks, how do you find the brokerage companies? They're out there. Google is a great resource for tax certificate brokerages. Also, if you go on our website, we've had some people from different service providers. If you search tax liens and certificates, we've had some guests on there that can also help you and maybe guide you on your journey for finding more of a brokerage. But again, it's not necessarily something that we can just give you the direct contact for. So Google is always a great place to start. And then if you have questions about people you find, feel free to give Corey or myself a call and we can kind of help you out further from there.
Any other last questions before we officially wrap up and close the session today? Feel free to get those in here in a moment.
Sue Ellen, I see that you're putting your email out there. What I'd recommend to you, Sue Ellen, is that if you have a service for providing tax certificate brokerage, although I can't give your information out here in this scenario, every other week we have an event called Pitch, Promote, and Prosper, where we allow anyone, where they can be clients, non-clients, contacts alike, on a Zoom call, where we allow for people to, give an elevator pitch on video to everyone, then also put your information in the chat box that we don't save or distribute. But if you have a service that you're looking to put out there, that'd be a great opportunity for you to come be a part of that. Again, every other Friday, go to our website, advantaira.com/events. You can register for it. And if you have a service that would help people like this, that's definitely the place to do it. We'd be happy to put it on, just legally and things like this. When we're educating people, we can't give out service provider information. So love to see you on one of those.
And that the next Pitch, Promote, and Prosper is this upcoming Friday, the 7th. You can find that on our events tab on Advanta's website to register. It's put on about 12 noon Eastern time. So that'll be the next one, and then every other week following.
Yep, exactly. So like I think we'll go ahead and wrap this up. I think we're hitting right on the door of 1 o'clock. So again, I'm happy that we got through an hour of content. That was going to be a little bit shorter. Hopefully everyone found this very informative. I'd like to thank my co-host, Corey Daharsh. Appreciate you being on with me today and getting through this. It's always a pleasure working with you on these. If there's any final remarks that Corey has, I'll let him say that, and then we can go ahead and let everyone get on with their day.
No, I do not really have any final remarks. Thank you, everyone, like Alex said, for participating and attending. It's been great questions and answers today, and we've got about 65 or so attendees at one point, so a good participation, and I thank everyone for being here. Again, if you missed anything or you're looking for the recording, we will have that posted about 1 to 2 business days, or if you're looking for the actual slide deck, you can email Alex or I as soon as the session's over, and we'll be happy to provide you copies of the slides from this presentation. Thank you so much, and have a great rest of your day.
All righty, thank you.